Hi, and welcome back again to Tim Bigham's Big Time Options. We'll be taking a look at why there are three big reasons to finally be bearish on Carvana CVNA. As we always do, we like to bring in a fusion approach using fundamental, technical, and especially IV analysis to find the edge and then put on that hedge. So let's jump in and take a look, shall we? First of all, from a fundamental standpoint, here was Carvana at the close today. You can see price to sales now approaching 6 times price to sales, by far the richest multiple we have seen over the past 3 years. PE ratio now well over 100. The last time it approached 100, and we'll take a look at the chart in a second, did prove to be a top in the stock, at least short term. So certainly the valuation multiple is getting to extremes here. My favorite one is probably price to free cash flow, now at over 125 times, believe it or not, which is just, I think, the height of insanity. You can see that going back, 5 years, the company wasn't making any money, it was on the verge of bankruptcy. Now everything is just hunky-dory, right? And the valuations are absolutely off the chart. Also, Carvana hit the $100 billion market cap today. The stock was up another 2.5% today, closed at another fresh new all-time high. We'll take a look at the chart in a second, just how high that high has become, right? And you can see here, compared to its main two competitors, AutoNation and CarMax, which are both valued at well under $10 billion, right? All three sell about the same amount of cars, 500,000 to 600,000 cars a year, but you can see that AutoNation valued less than 13 times, what Carvana is now valued at, and Carvana is now worth 17 times more than CarMax. Carvana on pace to probably sell 600,000 cars this year. I did a quick little fun sort of math, problem here, if you will. So I doubled the car sales. Let's say they hit 1.2 million cars, right? Which would be doubling it, which is a big stretch, right? And valued at that $100 billion market cap, right? Slightly under the 101.74, right? That values every car, right, at $83,000, right? So certainly things are getting a little bit out over the skis, in my opinion, in Carvana. When you take a look at it from a technical perspective too, you can see the stock, after kind of bottoming out near the 300 level, has rallied over 50% just in the last 12 days, right? Has been up 12 straight days, breaking out above that kind of resistance level at 400, right? You can see the last time that PE approached 100 times, right, as we talked about here, the last time we saw that multiple nearing the 100 level was in this time frame, which marked a short-term top, certainly in the stock, until just recently, right? On the technical basis, 9-day RSI well over 80, approaching 90, the highest level by far in the past year. We have MACD at a just off the charts over 10, right? Extreme here. Bollinger percent B still over 100. And you can see IV now at the lowest level we have seen in a very long time as well. What does low IV mean? Complacency setting in. And more importantly, option prices are getting cheap. You can see that the stock, it was added to the S&P 500, right? But to put on basically this sort of run, right, just for the addition to the S&P 500, yeah, there's going to have to be some people coming in to buy the stock. It's not going to increase their car sales by any stretch, right? But it did increase, as we said, those valuation metrics to borderline ridiculous extremes here for Carvana, in my opinion. We shall see. But it's come to the point where you're getting to the most overvalued, the most overbought, and probably some of the cheapest option prices we have seen. At least, right, you have those three edges going in. As far as the option prices, I pulled off the IV here, and here's the IV. As you can see, it's just kept going lower and lower. I use the 60-day IV as kind of a general benchmark, right, nearing that 50 level, which has proved to be basically a floor many times, right? It also, as we said, signals many times that things are getting a little complacent and might be a short-term top in the stock. Things getting a little on the hand. You can see it dropped again today, and I did a comparative from yesterday to today. Yesterday, the IV percentile only 14%. Today, even lower at 12%. Here you can see all the expirations dropping, right? Here is Carvana going back 6 months from an IV perspective, right? So here is that big spike earnings base, right? Boom. The stock is now approaching those lows from that September area, which was the last time the stock kind of hit that almost 100 times valuation, right? So this kind of move lower means option prices are getting cheaper. Also, things are getting maybe a little bit overdone on the price perspective. So that sets up, I think, for a few option trade possibilities, right? Kind of pulled them off here. A simple put calendar spread trade, going out buying the January 410 put, selling the December traditional 410 put, paying about $7.55 net debit here. Doing a diagonal, which is a little more bearish, right? You're buying that same 410 put in January, but selling the 405 put that expires a week from Friday, paying a little bit more for that, right? Receiving a little bit less premium. And you're really, when you look at what you're kind of receiving for those hedges, if you will, and we'll have to open this up to all simply because of the multitude of strikes. But you can see by selling that 410 put in December, the 19th traditional, you defray the cost by about $1.50, the 405 by about $1.20, which certainly with time premium, right, you have good theta, right? You're in essence saving 30 to 35 cents a day over that time frame. So I think it makes a lot of sense to position either with a straight put calendar spread trade, buying the 410 January traditional 16th expiration, selling the December traditional 19th expiration, and again paying about $7.50, or doing a diagonal where you're a little more bearish, pay about 30 cents more, but you defray a lot of that time premium decay effect, which can be, even though IV's lower, time premium's less, you still, if you can defray it, you want to find that edge and then put on the hedge. And the other nice thing about doing these sorts of trades, right, is you have all of these weeklies, right, December 26th, the 2nd, and the 9th, 3 sets of weeklies to continue to what I call chop wood, sell additional puts if the shorter term put expires worthless, bring in more money, reduce your costs, right, just waiting for that pullback to happen. And we're not even looking for a pullback, doesn't even have to go in the money, a move back towards 410, right, over the next month or so will certainly set up ideally for this trade. And another simple way to do it, kind of more set it and forget it, go out to January and just buy the 410 400 put spread, paying just under $2 for that. Potential gain is $10 less the 2 paid, or $8. Your risk is $2, right? $200 to make 800 if Carvana closes below 400 come January expiration. Of course, the stock drops. In the interim, you can sell that spread for a gain. So that's how we go about identifying opportunities here, simply based on the fact that we're looking at a stock that is historically overbought on a technical basis, as we said. RSI, MACD, Bollinger Percent B at extremes, trading at the biggest premium to the 20-day moving average, right? Broke out above 400 because of the addition to the S&P 500. We see how long lasting that is, up 12 days in a row. Also a valuation basis, as we said, trading at extremes on valuation multiples and also at big extremes to the competitors, and then price at a ridiculous amount if you use that $100 billion-dollar market cap now for Carvana by the amount of cars, double the amount of cars they're going to sell this year down the road, right? And it's still impossible to justify this. And while you're doing it, you're buying the cheapest options we have seen in a very long time. So this doesn't mean that this trade worked out. No, trading is all about probability, not certainty. But if you put the edges in your favor, hedge accordingly, and position size properly over the long haul, you should do just fine. So until next time, as always, here's the good trading. Take care.